Greetings. So as you must have been following in the news, the Federal Reserve is continuing on its aggressive taper policy, as well as embarking upon rate increases, which is exactly what it should not be doing, as I've explained on this channel many times. The amount of quantitative easing that has to be done worldwide has to rise exponentially just to offset exponential technological deflation. And more simply, the Federal Reserve has done exactly the same thing about 5 times before over the past 11 years with predictably bad results because they don't understand the first principles of technology and economics. They are very theoretical creatures. They react to things that have only happened 12 to 18 months ago and never look towards the future. And I will explain what that means. But they are repeating the same mistake that they have already made many times under a belief that now they can permanently end QE and return interest rates to a 3% Fed funds rate, which is insane because they haven't had a 3% Fed funds rate in over a decade and they never will. So let me take you over to the transcript of Chairman Powell's speech, and nothing about him in particular. He is just the representative of the entire body of PhD economist thought. So this is the FOMC statement from the Calculated Risk blog. And what we'll do here is look at the highlighted part from Chairman Jerome Powell. Participants generally agreed that monthly caps of about $60 billion for Treasury securities and about $35 billion for agency mortgage-backed securities would likely be appropriate. The Federal Reserve wants to deprint by $95 billion a month. 60 plus 35 is $95 billion a month. That is what they want to do. They believe they need to undo the money printing they have done in order to halt inflation. Now, the last few times they did it, there wasn't even inflation. But this time, the inflation is not because of the Federal Reserve. The inflation is because the U.S. government has stopped oil and gas production domestically, which of course has caused oil and natural gas prices to rise, which has caused some international disturbances, shall we say, which causes oil and natural gas prices to rise further. So the inflation is entirely because of that, and it's very temporary for those reasons, at least to the extent that domestic oil and natural gas production, if resumed, would result in a reversal of the inflation that was caused by their increase. But the Federal Reserve wants to deprint. And this video is going to be relatively brief because I'm still gathering my thoughts, and I will communicate about this in subsequent videos, including my monthly updates to monetary creation. But this is insane. $95 billion a month in reversal of printing. Reversal. Now if we go to the Yardeni Report, I'll have my usual monthly update about this as well. But as you can see, the United States is only 25% of the entire world's monetary creation, this red line. So it's about 8.9 trillion out of 31.5 trillion. And they want to go in reverse, so making the red line go in reverse. The blue line, which is Europe, and the green line, which is Japan, is already slightly going in reverse, but the US wants to do it in a very super fast clamp down way. And this has been the exponential trend of monetary creation increase, and they want to go in reverse from here. They want to undo this. The trend line is very clearly a parabola, and by going in reverse, there will be a stock market crash and a reversion back to this mean. And I'll be speaking about that in other Crash Watch videos about the imminent market correction that they are forcibly engineering, just on account of some inflation that is not the fault of the Federal Reserve. So ideologically, these PhD economists have learned nothing. They still believe all of this money printing has to be reversed, despite the fact that the stock market has entirely internalized all this money printing, and any reversal will cause a recession. Simply going back to the amount of cumulative money printing of 2 years ago, which would be a reversal of $12 trillion down to here, would cause a super deep recession, and the stock market would simply not allow the Federal Reserve to even go that far, especially in combination with all the other central banks of the world, because the Federal Reserve is only 25% of world money printing. And with that, we then go to my own scorecard over here. So this scorecard I show pretty often. In the 2010s decade, the central banks of the world did a cumulative $23 trillion of money printing that we saw in that Yardeni report as well. And PhD economists, because they still think a normal situation is for Fed funds rate to be at plus 3% and for money printing to have been a temporary thing that they wish they didn't have to do, They believe the 2020s will be minus 23 trillion, whereas I said because of exponential technological deflation and the QE needed to offset that, the 2020s will have 50 to 100 trillion dollars of net new money printing above the first 23 trillion. Remember, the 2010s had the first 23 trillion. $50 trillion if it's more in the form of cash sent directly to people, which is what it should be, but about $100 trillion if bond buying still. Now, bond buying is reaching its end, which is why they can't diagnose the problem properly, but that's a subject for different videos. And to date, in the first 27 months since January 1st, 2020, so 2 years and 3 months, things are trending closer to what I'm saying because the central banks of the world have done plus 12 trillion more. So they're not even going in the negative direction of minus 23 trillion. They have done plus 12 trillion. And since this is exponential, in the remaining 7.75 years of this decade, they only have to do about 38 trillion more to hit the lower end of the number I'm saying if they do cash, and quite a bit more if they want to hit 100 trillion if it stays as bond buying. But nonetheless, things are trending in the direction that I have predicted, which is of no surprise because these PhD economists have no concept of the first principles of technology and economics. They know nothing about the purported subject of their expertise because that entire profession is built around a number of models from the mid-20th century, and people get promoted in that profession and even win the highest prizes in that profession by repeating dogma that other PhD economists have memorized, and no one ever tells them that they're wrong, and they don't believe that anyone who doesn't have the same degree as them could possibly figure out what is going on in the field of economics. To the extent that there's any major field where the primary establishment of that field is out of touch with the actual reality of their supposed area of expertise, nothing is more disconnected than the field of macroeconomics. Nothing at all. But since they believe that they have to get to negative 23 trillion, that's why they are going on an insanely fast reduction of balance sheets. So from plus 12, if you want to go from plus 12 back down to minus 23, well, 95 billion a month is the rate that they should go. So that's why they are undoing printing at the rate of 95 billion a month. Before, the Federal Reserve was in fact the customer of U.S. treasuries that the U.S. government issues to finance the deficit. Now it's the competitor because it wants to sell back treasuries while the federal government itself is also selling treasuries to finance the national debt. That's a lot of selling of bonds leading to lower prices of bonds and higher interest rates. Higher interest rates crash the housing market, as I speak about in this video over here. Unusually low interest rates make people buy more homes because people don't realize that the time to buy is when interest rates are high, not low, because the price adjusts upwards as interest rates go lower. And your chance of making any home equity gains are much lower when you buy at a low interest rate than when you buy at a high interest rate. So the housing market is also very, very cornered, and now they're selling back the mortgage-backed securities that they bought. The Federal Reserve owns about 40% of the entire U.S. domestic mortgage market, which is also a huge distortion. That's why they should only print money in the form of cash sent directly to people. But now they're selling back these mortgage-backed securities. So by selling more mortgages, interest rates rise, and anyone who bought a house or at least made a lot of home equity gains is going to see that reversed. It is going to be a huge disaster because they think they have to go from plus 12 trillion to minus 23, rather than realize that the simple market forces, the first principles of technology and economics, the first principles of nature itself, want this 12 trillion to continue as is and get to this 50 to 100 trillion range by 2030. Everything will be better and more prosperous if they simply understood these first principles. And again, I'll have many, many more videos about this, but this was just a brief highlight of the rate at which the Federal Reserve wants to taper and how they've really learned nothing. They've done the same thing about 5 times. Each of the 5 times it caused a market crash, which forced them to do more printing than ever before, and hence that exponential curve, which is in fact natural and normal if they understand what it is. But these are flat earthers who are trying to force other people to believe that the earth is flat, and the costs of them not accepting that the earth is a sphere effectively are being borne by average people in terms of lost jobs, mortgage rate increases that make their homes underwater and negative equity, and stock market crashes. It is quite unfortunate, and while I did say a lot metaphorically, I'm at a loss for words that they would want to deprint at the rate of $95 billion a month, because pretty soon, within a year or two, they're going to be printing more than ever before, simply because they are forcing themselves away from the trend line, whereas market forces are going to penalize anyone who forces an entire economy to go away from that natural progression of an exponential trend line. PhD economists will never admit anything was ever exponential. They can't answer what the world economy was like 1,000 years ago, and how you could not have had economic growth 1,000 years ago at a compounded rate that we're used to today, because then we'd be much further along. These are simple questions that they have no curiosity of at all. But a lot of videos to come in the next few days. This was just a series of highlights about the imminent and unfortunately negative historical events that are going to occur in the near future and are entirely unnecessary. If you find this type of content informative, and if you feel this increases your understanding of the complexities of our world, then I encourage you to subscribe to this channel. Thank you very much for watching.